Good morning, everyone. I'm David Scherer. Welcome back. If you've been to some of our webinars prior in the last 3 or 4 months, I'm co-CEO of Origin Investments. We're both a private and public real estate manager. Our private funds to date, we've invested over $1.5 billion across the country into primarily multifamily assets. We currently actively manage 4 funds, and we've completed our first fund 2 years ago. Today, we're going to talk about real estate, why it should be in a portfolio, why that portfolio should have both public and private real estate holdings and the benefit of that, both from a return and a risk mitigation and a liquidity standpoint. And then we're also going to touch on why you need active management on both your public and your private real estate investments. I'm joined today by Geoff, who I have the pleasure of working with on a daily basis. Geoff runs all of our public real estate portfolios. We call them our REIT blocks, and we'll talk about those in detail in a moment. Geoff also he's been specializing in this space for over 15 years, and we're going to do a Q&A feature, which we always do. Just a little housekeeping. If you touch your screen, a Q&A function will pop up. Please ask questions. Please be specific. We're going to try to make this interactive like we did last month. Geoff is a virtual encyclopedia on public REITs in the US, so I would challenge you to be any question as specific as you want. It won't matter in terms of what comes back. Real quick, Geoff, just to start us off, you and I, at your suggestion, spent an entire show on lab space, and that was about I'm thinking 6 to 8 weeks ago. At your recommendation, we highlighted a space, and the reason I'm bringing this up is why don't you talk a little bit about what's happened in lab space, and this is really a subset of office in the last 6 to 8 weeks. And how that might actually be an interesting starting point at why active management matters.
Yeah, no, and we highlighted lab space on a webinar and wrote an article about it. And really the thinking was, people can work from home pretty easy. I am here, granted you're in the office, but what you can't do is recreate a lab in your house. Nor would someone, say during this pandemic that is, working on creating a vaccine, would they want to take live samples of a virus home to their house? I'm pretty sure their spouse would, lock the door and kick them out. So we just had the foresight to know that the demand for this sort of space during this pandemic and in the future is just going to see greater demand, as we try and tackle, whether it's antibody testing, virus testing, all sorts of virology. It's just going to have more and more space. And these things usually happen in clusters. So there's a select group of markets that's really important to pay attention to. Places like Cambridge in Massachusetts or South San Francisco, where you've got these clusters of life science activity. So it's just an area where if you can see what the future demand is going to be, you've got a greater edge than simply taking index results. And I think the Wall Street Journal even had an article yesterday highlighting the immense amount of capital that's currently flowing into biotechnology related properties right now.
Mm-hmm. So let's backtrack just a second and talk about, I think the first question that we need to answer or even pose is, why should real estate be in your portfolio? How much your portfolio should be real estate? And before I kick that to you, Geoff, I just want to be clear that when I think about real estate in a portfolio, that doesn't include your home. Your home is where you live. It might wind out to also be a good investment. It might be an average investment, but it's not an investment in the sense that you're living there, you're consuming. So I would pull that out of your real estate equation in your portfolio. That doesn't matter as an investment. Number two, when I think about real estate investment, it has to be a proactive decision to invest in real estate that then results in a portfolio construction that is real estate. And far too often what I see instead are people who sort of cobble together their real estate allocation. Maybe they get 3 to 4% by being in the S&P 500, and that's true, that there is REIT exposure there. But then on the private side, what usually happens that I see is they either invest in one private fund or they invest in one deal or two deals. And obviously there's very little diversification across asset classes, across geographies, across management teams. And that to me is reactive, right? If you wind up in one fund and one deal, it's a development somewhere, that's not a proactive strategy. And so the mission of Origin, more than anything else, is to make sure that that happens less. We want people to be number one in real estate, and we'll tell you why, but then we also want people to be proactive about the portfolios they construct within real estate as an asset class. And so can you talk a little bit, Geoff, about, and I know you have a couple slides prepared as well, but why real estate number one? And that would be both returns and the lack of correlation with some of your public alternatives, which increase the total expected value of the portfolio and risk of the portfolio lowered. And then also maybe the frontier slide you have that talks about what the optimal mix of public-private would be.
Yeah, sure. So, let's first start off with, looking at returns. Now, granted, I'm going to show you here, if you can see this. Hopefully, Dave, you can see this now.
Yep.
And hopefully people on the webinar can see this as well. This is a graph of the total return of REITs, or a specific REIT index, the FTSE Nareit All Equity Index, versus the S&P 500 over the past 20 years. And over that time, the REITs have returned almost 800% total return. So again, that assumes the reinvestment of dividends, while you're about 225% on the S&P. So when this is REITs, but I believe if we showed private real estate returns too, using some sort of proxy, maybe the NCREIF open-end diversified core, you would see that the Odyssey also outperformed the S&P 500. And I know we're just showing you 20 years, but I believe we published and we've shown this, or we could, that REITs have beaten the S&P 500 not just over 20 years, but over 30 years and over 40 years. So REITs have generated better returns than the S&P 500 over some very long periods of time. It's not the case that always holds, right? Right now we're in a very unique pandemic. The S&P 500, basically call it flat, while REITs are down, call it 10 to 12% this year. So it's not always going to be the case, but again, over longer periods of time, REITs have definitely outperformed the S&P 500. You mentioned correlation. So I have here, if I can get to it, a correlation matrix from CEM Benchmarking Group, and they published this in October of last year. Granted, it shows the 20-year period, so a good period of time that ended in 2017. And if we look at the listed equity REITs column, so that is REITs, correlations with the U.S. large caps are 0.5, small caps 0.6, international stocks 0.6. So it's not a correlation of one. Sometimes REITs zig when the stocks zag. Sometimes it's the reverse. But what we do see down here at the bottom, the correlation between listed real estate and private real estate is 0.91. So I think there's a misnomer out there many times that people say, REITs are just stocks. They're going to act like stocks. They're going to move in lockstep with the stock market. And I'm telling you right here, this correlation matrix shows you that that's not the case. There's some correlation with the broad markets, but really over the long run, they move more like real estate. On any given day, if there's a panic and the stocks are selling off, yes, the REITs may, do the similar things, but over a longer period of times, they really act like real estate.
So Geoff, let me jump in. There's obviously a lot of data on this page, but the concept here is that you don't want all of your assets moving at the same direction, at the same rate, at the same time, right? So if the stock market's going to go up a lot or down a lot, you want other assets that don't go in the same direction as fast. And that's what portfolio construction is all about. Like ideally, you not only have a lesser correlation, but you have a negative correlation so that your asset is going up in value when another is going down in value. And that's smoothing the overall portfolio. The fact that real estate generally is a 0.5 to a 0.56 with the stock market, it's notable, right? Because if you look at large caps or small caps, I mean, they're going to behave almost the same, right? And so that's one of the things that even public real estate a benefit it offers. And I'll segue into private real estate because Geoff, then I'll kick it back to you and you can talk about the frontier a little bit. But in private real estate, you have even a lower correlation with the stock market because REITs, publicly traded REITs, are included in the stock market. And just the index effect itself, it's going to pull it higher. So like if it's part of the S&P 500 and the S&P 500 is going up very quickly, it will also pull the publicly traded REITs up too, whether it's the fundamentals or not. That's not going to happen in private real estate. And in a lot of instances, I'll give you one that was very recent. In the fall of 2018, the Fed was actually raising rates. I know that sounds crazy now, but they were. And you know, Q4 wound up being a really difficult quarter in the market broadly. And REITs also corrected quite a bit, 15, 20% in a, you know, call it 12-week period. And the private markets, they didn't change. I mean, valuations didn't change at all. And so we're looking into 2019. And what happened? Well, the Fed even, you know, this is way before COVID, but the Fed started to change their policy. And they not only stopped raising, but they started indicating that maybe they overshot and they were going to start lowering rates. And what happened was the public REITs completely recovered and then wound up having a really strong year in 2019. And what happened in the private markets? Well, in Q4, we didn't really correct. And in Q1, we didn't really race back because we had nothing to gain back. And then, you know, we wound up having a pretty good year in the private markets, but the standard deviation of what happened in the private side was just way, way less than the public side. And in instances where the public market is overreacting and then self-corrects, which happens quite a bit, the private market just doesn't pick it up at all. It doesn't happen. Our cash flow streams remain constant. The valuations remain constant. Now, in the issue of the pandemic, because you know we're in an issue right now where the stock market repriced and it was actually correct, and the fact that this is a paradigm shift. Demand has changed. The world has changed. The private market directionally starts to follow, but it's slower, number one, and it's almost always like the public markets is indicative of direction, but not magnitude. So if it's down 20%, the private market also is lower, but it might be down 5%. And so that's the benefit of the private side is there's just less standard deviation of what's happening than the public market. With that, Geoff, can you maybe talk about the difference between public and private and how they work in a portfolio?
Yeah, and I think you know what we did, and you know, we did an analysis on this, and we actually published this. This would be on the Origin Investments website under the education section. But we looked at returns from REITs and private real estates using the NCREIF open-end diversified core. And let me share some data with you and the efficient frontier that Dave mentioned. That is here. So this is just going to be some data, but we're going to need this to see how we created the efficient frontier in a second. So we looked at the returns of listed real estate, i.e. REITs, and private real estates using the open-end core diversified end fund. And what we found over a 20-year period that ended with 2019 is that REITs on average returned 11.6% per year, while the private real estate returned 8.2. That's this first row here. looking at the volatility, as Dave mentioned, REITs can move up and down, they can overshoot. REITs were much more volatile than private real estate. So you kind of have a conundrum here. One had better returns, but higher volatility. And the other had good returns, but not as high as REITs, but with less volatility. So how can you combine these two to create a portfolio that, maximizes return for a given level of risk? And so what we did is we started looking at, various portfolios. Hey, we're going to take some mix of private and public real estate. And so this column here is if you had a portfolio with 75% private real estate and 25% listed REITs. And what we found there was you would have had an average annual return of 9.1%, but your volatility would have been less than owning entirely REITs or less than owning private real estate by itself. So there's a measure out there known as the Sharpe ratio, which is really just a measure of risk-adjusted returns. And we found that you can maximize this risk-adjusted return using a combination of public and private. So what we did is we took all the combination of owning a mix of private and public, and we came up with the sufficient frontier. Now this sufficient frontier, if you've seen these before, should be noted, this is in a universe where your only investment options are public, private, or the risk-free rate. So we're not including, hey, how do these things perform with the bond portfolio? How do they perform with large cap? It's simply you can own treasuries, private or public real estate. And we found that Sharpe ratio was maximized somewhere, it says 75-25, it might have been 78, it's going to move around, but you can get better returns than simply owning private with less risk in this segment of the curve here. And somewhere around here is where you would maximize your Sharpe ratio. So if you're looking to maximize risk-adjusted returns, somewhere in the neighborhood of 80% private to maybe 70% private with the bulk and listed real estate maximizes your returns. Of course, you can always go further out the curve and own more REITs, more listed real estate, and have higher returns. But granted, you start to introduce more volatility into your portfolio.
Thanks, Geoff. And can you go back to the previous slide for one moment?
This one?
Yeah. So Geoff's absolutely right. And this actually segues really well into the third topic I wanted to cover, which is why active management. And we'll cover this, Geoff, both in terms of public and private. And I'll take a stab just based on this slide about why you need active management in private real estate. So if you look at the top left under private real estate, total return 8.2%. That's completely correct, except for that's the average, right? And I would tell you that, and this is both my opinion, but it's also just, it's data-based. If you segment private real estate managers, we're one, Origin is one, by top tier, middle tier, lower tier, there's a massive dispersion, right? So 8.2 is the average, but if we said, okay, now let's look at the top 20% of post net returns to investors, that would go all the way up to well above 10%. And that's really, like, on the private side, what you're either doing yourself with your own diligence and research, or you hire a consultant to do, is you're trying to figure out who is going to be the best management team with the best strategy and execution to deliver that. Origin, I'm proud of this, so I'll just plug this. This isn't about Origin, it's more conceptual, but we've been a top 10% as measured by Preqin manager in our first two funds, Fund 1 and Fund 2. Being a top 10% manager makes that much higher than 8.2%, and we could do, and we do a lot of shows on the why. The why always boils down to, do you have competitive advantages in sourcing deals? Do you have competitive advantages in executing business plans? Do you have competitive advantages in risk management? Do you have a culture that's aligned? Do you have business practices that build infrastructure and retain key people, right? So once you get into the why, it shouldn't sound that different than any other business, actually. Like the things I just mentioned probably apply to cross-functional business. With that, I want to give it back to Geoff. I'm kind of segueing into active management now, but what do you look for? Like, first of all, Geoff, I know you're a big believer in active management because you've spent your entire career beating or trying to beat indexes. I mean, that's what you do.
So, right. And so, I mean, remember with an index, typically they're market weight capped. I mean, that's even the case for, the S&P 500. And you get a concentration in the names that have the highest market caps. Now, you mentioned dispersion, between real estate managers on the private side, and even within multifamily, there's a pretty big dispersion. But one thing that we see in listed real estate is the dispersion of returns by property type. I'm going to share another slide with you here. See if I can pull this one up. And this is a new piece. Dave, can you see this table here now?
That's a lot of info, Geoff.
It's a lot of info. This is a new piece that we created. We're calling it our periodic table of REIT property returns. And it is available on the pathbyorigin.com website. And in fact, I believe the version that we have on the website actually has 20, maybe 21, 22 years worth of data. And what we're seeing here is REITs broken into their property type each year, and the returns within those property types, if you own everybody that owns the same property type weighted by market cap. So I'm going to try and zoom in here to 2019, if you can see this. And here you can see that in 2019, manufactured homes returned over 49%, while at the bottom, malls were down 9%. So the difference in returns between malls and manufactured housing was almost 60% last year. If you just own the index, you fall somewhere in the middle here, 29%. So if you were wise enough to own more manufactured homes and less malls, your returns could have been better than the index return. And as you look at this table, there's a difference every year. You look at 2017, infrastructure, that's mainly the cell tower owners, were up 35%, while shopping centers were down 11%. These are huge dispersions of returns just by property type. And if we were to dig into each one of these property types, there's a handful, anywhere from 3 to maybe 20 stocks that make up each one of these property types. There's dispersion of returns between those individual stocks as well. So that means within 2019, when manufactured homes returned 49%, one of the stocks might have done better than 49%, and one of them might have done worse than 49%. Which, we do know, well, I know they both did better than malls. So you can do better and then even better within manufactured homes. So again, with index with an index strategy, ETF or mutual fund, you get everything, and it's market cap weighted. You get the good, you get the bad, you get the other. You get the worst stocks, you get the best stocks. You just get everything. But with active management, one, you can hope to gain alpha by picking the right selectors. That would have been manufactured homes in 2019 while not owning malls or self-storage. And then again, by picking stocks that may or may not have the largest market cap. Again, with the index, you're going to have large weights in the largest market cap just by definition. But it might be a mid cap or a smaller REIT that actually does better, and you don't even have a chance at picking up that equity or picking up that alpha with passive management.
Yeah, that's a good point. And we talk about this a lot, Geoff. The two ways that Geoff and myself and my partner Michael and the people making decisions on portfolio construction can add value is, number one, where are we weighting the index? Where are we tilting it towards, right? And by the way, that's based on our future growth expectations, but also the valuations in the market today. Right? The way to make better risk-adjusted returns in the public stock markets are to pick the sectors that you believe are going to grow, but also the growth is going to exceed the P today, right? If it's just an incredibly expensive stock, you can have growth and you still don't win. You have to look at both. The other thing you need to do, and we'll touch on this very briefly, is why don't you let's take a sector. So since we were talking about, and by the way, this will be interesting for people watching because this isn't scripted. He has no idea what sector I'm going to pick. So it's kind of fun, and you should do the same with your questions. So let's pick a sector. How about multifamily, since obviously I have an interest there. Within multifamily, based on the management team, the balance sheet, where they're investing, where their portfolios are weighted, right? Because these REITs have national exposure, and if they have a lot of exposure in San Francisco right now, that's a very disrupted market, right? But also the price of the stock, cash positions, future growth opportunities, development pipeline, all the things you look at. What's your favorite publicly listed apartment REIT and why?
Oh, right now, gosh, my favorite apartment REIT right now would have to be Camden Property Trust. The ticker is CPT, right? So they're a Houston-based multifamily REIT. They have a national portfolio, but the reasons that I like them are, one, the markets that they're in. I'll be honest, they have some Houston exposure. Houston's been having some trouble, obviously, with the oil prices. But really, their portfolio is spread amongst the Sun Belt, places like Atlanta and Charlotte and Phoenix. And we're just seeing better, and I hope you would agree with me on the private side, but we see a better outcome in some of those places versus a New York City or a San Francisco right now. I mean, rents are falling dramatically in New York City. During this pandemic, obviously New York City got hit hard first, but it's just such a dense place. And people have left, people have moved in with their parents, and rents are falling there. We're seeing some of that on the West Coast as well. San Francisco would be the prime example, but also Los Angeles. So I like Camden because of their exposure to the Sun Belt, but also, I mean, they just have a rock solid balance sheet. They're investment grade rated. They are frugal with their capital. They're rather conservative, and they're not going to put the company at risk due to breaking bond covenants. And we do see more so with some of the smaller cap apartment REITs. They're highly leveraged, and that means that when asset prices go down, and Dave mentioned this earlier, if asset prices fall 5 or 10%, the more leverage you are, the more your equity is going to go down. So if multifamily asset prices have dropped any bit, it's just magnified for the more leveraged companies. Camden, with a more conservative balance sheet, has felt less pain than some of those more highly leveraged companies.
Yeah. So what we're doing here is, if we're not going to be an index investor, which we're not, we believe in active management, but you're going to, number one, figure out the sectors that you want to overweight and underweight. That's the first decision in the decision tree. And the second is, once you get into a sector, you don't have to have all 8 to 10 apartment REITs in your index. What you want to have is your top 3 favorites, right? The ones that you really believe have the attributes that Geoff just mentioned. And here's the other nice part about active management, because Geoff's on every analyst call. He's constantly updating and researching the information that he makes his decisions on, right? So let's say the management team shows a lot of turnover, or the balance sheet changes, or they start changing their investment strategy. I mean, these things aren't fixed, they move. We can swap out that stock. We're not married to Camden. We like it today, but that doesn't mean in 9 months, 12 months, 15 months, maybe we might feel differently. And that's what happens in actively managed portfolios. That's what we're doing here all the time. Other things that are happening would be, tax efficiency elements. There's a lot that goes into an actively managed portfolio to make it tax efficient. The nice part about the private side, and I should probably add this, and we're talking about returns, those returns that you see, that's true, meaning the public tend to get higher returns than the private, but both public and private real estate are very tax efficient. And so if you start comparing those return sets to a less efficient investment, like for example, any debt investment, right? That's making its return from a loan, and you're collecting a dividend and interest, that's just taxed. I mean, there's no shelter. You're paying ordinary income, and that can be unbelievably less return post-tax than what you see in real estate. And we could do a whole show on that, but it's extraordinary how efficient real estate is as an investment versus some of your other options out there. Geoff, I want to actually, we're at 30 minutes. I want to move to questions. We had 3 or 4 questions prior, and I see that we have 5 that came in. Please continue to ask the questions. I'm going to ask these that came prior to Geoff. So the first question, Geoff, why would I want to invest in REITs when they correlate nearly 100% to the stock market?
Oh, we're doing true false now, right? So this item is false, right? If we looked at our correlation matrix, if I can pull it up here again, we see that REITs are not correlated 100% with the stock markets. In fact, over a 20-year period, it's 0.5 or 0.6%. And a really important thing to remember here is that REITs are one component, one sector in the S&P 500. The S&P 500 is made up of 11 sectors, with REITs being just one of them. And I think Dave mentioned this as well. REITs make up about 3% of the S&P 500. So there are some REITs in the S&P 500. But the statement of why would I want to own REITs if they're 100% correlated with the stock market? I mean, you could swap in, and why would I want to own energy if it's 100% correlated? Why would I want to own tech if it's 100% correlated? Well, the fact is, if you take any one sector out of the S&P 500, it will have some correlation with the S&P 500, but it will really move on the fundamentals of that specific sector versus the broad market. So I'm going to state that REITs are not 100% correlated with the stock market.
Right, and the answer is they're 0.5 to 0.6. I mean, that's what the table is showing. In terms of next question, are select REIT sectors like industrial, healthcare overvalued, or is there still good potential for appreciation, dividends, et cetera?
So yeah, these are 2 of 16 REIT property types that are mentioned here. I would say industrial does likely trade at a premium to NAV, so it trades above NAV. But I'm going to argue that healthcare has not had a great year so far. A lot of that is on senior housing concerns. That healthcare as a group, right, not any individual stock, but as a group, healthcare actually trades below NAV right now. And there's a handful of sectors that trade above NAV and a whole bunch that trade below NAV right now. So industrial, I'm not going to say that it's overvalued. It does trade above NAV. Potential for yield. So industrial currently has a lower yield than healthcare. But if I was a betting person, I would put my chips that industrial is more likely to increase their dividend rates versus cut them. While healthcare currently does offer a higher dividend stream, we have seen some cuts within the healthcare space. And there may be some more to come. So you might start with the higher yield today, but in the future, that yield could be reduced if more of these companies reduce their dividend distributions. And I want to mention, one more thing, because this is unique to REITs that they can trade above and below NAV. So on one hand, if they're trading below NAV, as an investor, it does give you the ability to buy real estate assets below their true market value. But just because a REIT trades above NAV doesn't necessarily mean that it's overvalued and a bad investment. As Dave mentioned before, what we're trying to do is predict the future growth of stocks versus where they trade now. And in a sector like industrial, you will likely see more growth and more demand than what the market is currently anticipating, which means that, even though they're at a premium to NAV, they could still outperform. And lastly, the fact that they can trade above or below NAV gives some very valuable tools to the management teams. If their stock is trading below NAV, they have the ability to buy back shares. They could sell assets and buy back shares, and that's instantly accretive. If their stock trades above NAV, they can issue, we'll call it cheaper. They can raise proceeds at a cheaper price and then buy assets at Main Street prices, and that too is accretive. So they had this ability to trade above, below NAV gives them some valuable tools.
Thanks, Geoff. So when Geoff is talking about NAV means net asset value, and essentially what he's saying is the valuations of all the real estate that the REIT owns, if you add them all up at a given point in time and divide them by the total number of shares, it's implying either a higher or lower value than the current stock market market cap, right? And we look at this very closely, both for the public and the private. And a huge advantage Origin has is we have experts like Geoff on the public side, but we also have a tremendous amount of private data that's ours and ours only because we own real estate across the country. And we also have a lot of talented people on the private side that are doing bottom-up valuations of real estate. And so it's interesting to be in both, and there's opportunities in both that constantly change, and we want to be in both for that reason. There are times, like for example, in March and April, when the public markets in real estate, they repriced to a point where there was nothing I could possibly have done on the private side that was even close to as good as an investment as just buying some of these publicly traded stocks because their stock price was so much lower relative to any reasonable assumption about where their real estate holdings had corrected to. And that's the benefit of being on both sides. It can work in reverse too. If the stock market goes up and REITs follow, or REITs just go up and they go up too much in a particular sector, why would we want to buy those when we believe we can replicate a much better private investment, right? So why would I want to buy industrial when it's trading at a massive premium to their net asset value? I can buy industrial assets or develop them. I would much rather do that, right? So it works in both directions. The fact that we can do both makes us, in my opinion, uniquely positioned to create real estate portfolios. And that's kind of the point of this entire webinar is to be proactive, to create a portfolio, to understand what a portfolio looks like, public and private, and then to execute it based on what you see in the market at any given time. There's an awful lot of times, by the way, where it's not, there aren't warpings in the market, right? And so NAVs are sort of trading relative to value of the stock, and the private and the public look about the same. There's a lot of time where that exists, and there's other times where they become very distorted. And those are the times that we want to act on both sides. Okay, so the next question, Geoff, I'd like to know Geoff's thoughts on purchasing a total REIT index fund and holding it for the long term.
Yeah, so I think, let me see if I can pull up, our periodic table here again. And, my answer to be is you could do worse. There's a lot of worse things you could do than buying an index fund and owning it for the long term. If you buy an index fund, we can see that your returns within listed real estate are always going to be middle of the pack. You're going to have some property types that do better and some that do worse. So, I mean, I guess as try and minimize your risks on both sides, picking an index, there's worse things that you could do. But owning an actively managed portfolio, that concentrates assets in specific property type, you have the ability to maybe pick manufactured homes over malls in 2019. Maybe pick the stocks that outperform their peers in the same property type. Don't even get that as an option with an index fund. So again, there's a lot worse things you could do. Try and pick one REIT that you think is going to outperform the index, only to find out that it doesn't over the course of the year. Or you could pick an actively managed product where the manager is striving to beat the index, both at an allocation property type decision and at a stock level decision.
I'm going to move to the live questions because we have 10 now. I'm not going to be able to cover all of them, but we're going to try to move a little bit faster. The first question I'll answer, Geoff. The question is, so long-term, you should own 75-25 private versus public real estate in your portfolio. I want to kind of address that. First of all, that's not what we're saying. We're saying that's the optimal frontier. Number one, all of these things should be ranges. So I wouldn't ever say 75-25. I would say anywhere from, 65-35 to 75-25 to 80-20. It depends. And the biggest thing that you need to keep in mind when you go into private real estate is that it's not liquid. And based on your own income, your own spending habits, your own balance sheet, you need to make sure that you have enough in liquid securities and liquid investments to always handle that. And I think that's a really common mistake that investors make, but candidly, pension managers make the same mistake. There's plenty of pension managers who over-allocate to privates and then realize later that, they're private for a reason. You don't just push send and get out. So I would say, number one, it's a range, and number two, be very aware of your own liquidity, and that's for you to decide. So the question went on to talk about multifamily REITs, and they're trading at discounts to NAV. Should I be investing in, the public apartments versus getting into private funds instead? And that's a very difficult question to answer. For example, maybe are they, first of all, let's start there. Are they trading at a discount to NAV? You have to be certain about net asset value before you can state that, right? So it could be that they are, it could be they aren't, but we'd have to go top down on every single stock and build it from the ground up. I mean, that's what we're positioned to do. And perhaps the person asking this question is too. But you'd have to do that analysis. Just because the stock's lower in price doesn't mean it's a discount to NAV. It means it's lower in price. And now you have to figure out, from a REIT standpoint, what's the roll up of the valuations of all the assets they own. And then the opportunity cost, if you're in the private side, what can we buy in the private side, and at what discount to pre-COVID activity is that happening, right? And so it's a very complicated question that would require more information to answer. So I'm going to ask you a question. So in terms of the total portfolio in real estate, this isn't the split public-private. It's just the question here is how much of a portfolio should be in real estate, period. And he says this particular person, I shouldn't say he or she, says, I commonly hear 10%, but I have a lot of people in my network who have 25 to 50% in real estate. How would you answer that?
Well, it is a range, and I think one thing to keep in mind, as you mentioned earlier on private versus public, is every investor is going to have a unique circumstance. If you have a child's college tuition payment due on August 31st, that better be in cash right now. You shouldn't have it in public real estate or private real estate. That should be in cash because you're 6 weeks out. So that said, I think there's numerous studies. There's one on the NAREIT site where I think Burton Malkiel suggested that the range is higher than most people consider. But that 10 to 25% range is very commonly used. And again, there can be tactical decisions as well. Right now, REITs are underperforming the S&P year to date, but we've seen on longer periods of time, they have outperformed. That could be a good sign that now's the time to start buying more public real estate as it's been underperforming the S&P year to date. But again, it's going to be a range. 10 to 25% is a good ballpark. It really considers, you really need to consider what your entire portfolio looks like and how real estate fits in with the greater portfolio.
There's a question about where we get our private real estate returns for your optimal frontier data. I believe you already answered that. That's from the NCREIF index. Is that right?
That was the NCREIF open-end diversified core fund.
Yeah.
So yes, they came from NCREIF, and it's a broad measure of private real estate measures.
So it's actually it's a cool question, and it ends with, after all, it's private real estate. How do you get the data? And it's a good question, but private real estate means that it's not publicly traded. And I sort of touched on that because that's why it's less liquid, and you need to make sure that you have liquidity in your portfolio. Private real estate doesn't provide that, so you need to be aware of that. Private real estate doesn't mean that the returns are kept private. Most managers, especially the ones that are doing well, they want to report their returns, right? So when I mentioned earlier that Origin is a top 10% manager on the private side, as measured by Preqin, that's because we submit our returns to Preqin, who take in all these returns and then segment them. And managers who are doing well, like Origin, we want to self-report into Preqin, who check and corroborate that, because obviously it's something we want to share with investors. So private doesn't mean private in that way. It means it's not publicly traded. Okay, so I think I'm going to have one more question. Question about the growth block, Geoff, and right now we haven't really covered any of the blocks really, but I believe we have an income block, a growth block, a safety block, a technology block, all on our Path website and app. Is that right?
And a healthcare block as well.
A healthcare block, right? Thank you. And so the question is, would you advocate investing in the growth REIT block now? Its yield is 3.7%, or would you consider waiting for some period of time, thinking the stock is likely to reprice lower? I think that's the idea. This is more of a question about, should we be getting in now or waiting? It's a timing question.
Yeah, I think most studies, and these aren't unique to REITs, I mean, most studies have shown that individual investors fail wildly at market timing, trying to call tops and bottoms of markets. Really what an investor needs to do is figure out what their ideal portfolio blend or allocation is across all asset classes. And you can make some tactical decisions, but figure out what your total allocations across asset classes should look like and get there. And then make sure that you review that periodically to make sure that those allocations match your current risk tolerance and your liquidity needs, and rebalance as you need to. Stocks, bonds, everything's moved around a lot this year. I bet there's a lot of people that have not looked at their overall allocation and may have more exposure to certain asset classes than they really anticipate. So I'm not going to say, oh, wait, because REITs are going to be cheaper in September, or say, hey, well, they're definitely going up, so, buy them now. But I'm saying figure out your ideal asset mix and get there.
Yeah, I've had this question a lot too. A lot of our clients are largely in cash, and they're scared. They're scared by the uncertainty in the market, and I can relate to that. I get that. Geoff's right in the sense that timing's a tough strategy in investing, and assets go up over time. They go up and down, but eventually they go up. And 28 to 10 is a great example. It would have been frustrating to invest a lot in 07 and watch everything go down 40%. But now everything you bought in 07 is up 2x. I mean, generally in the market. I mean, the market was 1,500 in 07. I'm talking about the whole S&P. It went to 800. That was frustrating. But now in the middle of the pandemics, it's 3,000. It's 2x what you paid. Markets tend to go up. You're not going to be successful sitting in cash at 0% return long term. Inflation is, in my opinion, higher than reported. Certainly mine is. The Dave Scherer inflation index is not 0.5 or 1% or whatever they're reporting. Mine seems to be higher. School for my children, healthcare, et cetera. It just seems higher to me than that. But that's not a strategy. Now, however, what I do tell investors who are nervous, but are thinking about investing, not necessarily with Origin, but in risk investments, is if you're in cash and you are nervous and specifically nervous about timing the market, like you don't want to put in a bunch of money and be down in a month. Well, let's just make it very real. A client friend of mine, had $1 million in cash, and we were having this conversation, and I said, well, you don't have to invest $1 million in a month, but create a plan and create an investment plan, number one, and then number two, maybe you want to invest 15% of it a quarter, and you stay 85% in cash in Q1, and then you move to 70% in Q2. But you've committed to a strategy, and maybe you wind up buying your last 7 blocks into this strategy at higher pricing, and maybe you buy it all at the same price, and maybe you buy it lower and lower and lower. I don't know the future either, but if that's what you're concerned about, there's a way to construct a plan where you don't just hit send and send it all out in one day. No one said you had to do that. But I'm just saying, please understand that staying in cash is a long-term losing proposition. It doesn't work. That's the sure way, unless you're making a tremendous amount of income every year, or you're really managing your spending. There's a lot of ways to get ahead in the game. You can make a lot of income. You can really manage your spending side. But another way to get ahead is over time. If you invest intelligently, assets go up over time. That's been proven. But that doesn't mean over 1 month or 1 year or 3 year. I mean over time, over a 10-year period. So let's go back to what I was saying about public-private. Private is generally a better investment. That's what the Sharpe ratios are telling you. They're higher. The standard deviation is lower. If you pick a good manager, the returns can be similar. But you have to manage your liquidity because these are long-term investments, right? You can't just say, private's better, I want it all in private. That's a mistake for 99% of the population, right? The 1% have enough total wealth that it doesn't matter. But the rest of the 99, you have to manage it all because these are long-term decisions. Geoff, do you want to add anything? Because we're at 53 minutes. I was trying to go to 45 today.
Well, I think that your strategy, to get to your ideal asset allocation of using dollar cost averaging is a great one. You don't have to make those sharp moves in a given day, but I think it can minimize regret for investors. If you put some of the money in now, some next month, some the month after, some are going to be up, some are going to be down. You might not have exactly called the bottom or the top, but you're going to get it right at one of those periods. So I think the dollar cost averaging is a great strategy.
Well, thanks, Geoff. And as always, it's a pleasure talking to you on these public seminars. And we didn't get a lot of specific stock questions. I kind of want to put you on the spot more next month. So if we don't get them, I'm going to do it myself. Okay. Thank everyone for your time. Thank you for your questions. We didn't get a chance to answer all of them, but I've read all of them, and I think I have some of the names of the people who asked. So we have your emails. We'll follow up with you individually. Thanks for your time, and let's all be safe, and hopefully we'll see you next month.